Now, for your money, stocks will open lower. I want to bring in economist John Lonski. Higher rates have weighed on this market. The bond market closed today. So it looks like equity investors don't have anything to gauge, right? This could be one of those rudderless sessions. What do you make, though? Okay, we pierced 3%. We were so afraid of it in February that the market collapsed. 3 sessions, we lost 3,000 points. And it seems to be, again, where we're so nervous about something that historically hasn't been a problem.
Well, you're up to 3.2% right now. You know, you do have housing sector share prices, according to PHLX. They're down by 18% for the year to date. We've seen home sales drop from their highs of the fourth quarter of 2017. Maybe there's some reason to be a little bit nervous about the damage that higher borrowing costs can do to the economy. That being said, I think the economy will be growing at close to 3% this year. It'll do well next year. We would have to perhaps see that 10-year Treasury yield break well above 3.5% if it's going to do real lasting damage to business activity.
It's just that, you look historically where these yields have been in the past, particularly associated with market tops. And, it's
well, what we want to be aware of is that the U.S. economy today is much more highly leveraged than it was, say, 2000, prior to 2000. And thus, the economy is going to be more sensitive to higher interest rates compared to what held in the past. And as a result, perhaps that comparison is invalid. What we want to watch is how interest-sensitive shares, housing, autos, and so on, respond to further increases by interest rates. I want to add one thing that was really interesting last week. The overall market last week was down 1.4%, but oddly enough, you know what was higher? The bond-like Dow Jones Utility Average finished higher by 1.8% for the week. Maybe that jump by the Dow Jones Utility Average is telling us that there are some on the equity side of the market that are betting on a near-term top for the 10-year Treasury yield.
Yeah, maybe we'll break out, consolidate here, and go sideways for a while. I do want to ask you about one thing I like. My research continues to tell me that the growth, I call them dirty fingernail jobs, right? Manufacturing, mining, construction. I love that because I think it's a heartland, John, and I think it represents the have-nots. And I think also it's a key component that gets missed a lot of times with the overall picture of our economy.
Yeah, that's a good point. You know, if you look at some of the recent wage data, you find that the average hourly earnings of workers in retailing, leisure, and hospitality are growing at a rate above the 2.8% average, growing something in excess of 3%. That's great to see because these people really are in need of a wage increase. And if we do that, we're going to draw more people into the labor force.
Well, it's manufacturing, for instance, right? I mean, almost 450,000 jobs since President Trump has inaugurated. Many people have given up on it. Those are great paying jobs. Mining, 53,000 since the president's been in office. We said there were never going to be any more jobs.
And now the problem we have in manufacturing is finding enough workers. But in order to get those workers, you're perhaps going to have to pay a higher wage.
So before we wrap it up, net, there's booming economy versus higher yields. Which one will prevail? Which one will dictate where this market goes into the end of the year, in your opinion?
Well, unfortunately, I think we have to see higher yields inflict some pain on the economy. And when that happens, yields will either stabilize or move lower. But the fundamentals are solid. We're going to continue to see earnings growth, profits growth. And with that, we'll have a further expansion of payrolls and an even lower unemployment rate. And my guess is higher productivity steps in. And as a result, despite the fact the unemployment rate eventually goes under 3.5%, we will not see inflation take off.
All right, so if we had that on the big board, it would look like one of those old math formulas, right?
Yes, it
for
would.
Nuclear fusion, but at the bottom we'll say up.
Okay, would I buy now? I would be very cautious.
Okay.
Would I hold yes?
Thank you very much, John.